Axis Bank's Q1 earnings report was all about exercising prudence amid the pandemic. In our Ideas for Profit today, I'll look at the policy tweaks done by the bank and the earnings fine print to find out if investors should keep this stock on their radar. Well, as a matter of fact, the abundant caution, the bank tweaked its accounting policies, changes in the fee recognition from upfront to amortization, incremental provision on the red flagged accounts, more conservative accounting of the investment depreciation, leading to a higher provision and also creation of an NII reserve. Now, the bank has been stepping up its provision for a while, and the trend continued as it made additional provision of 733 crores for COVID-19 in the quarter, on top of the 3,000 crore rupees created in the previous quarter. Now, the provision cover has risen to 75% from 69% in the preceding quarter. The bank now holds additional provisions of over 6,800 crores and above its standard asset and NPA provision, that is. Now, asset quality was stable but of little consequence amid the moratorium granted for COVID-19. Now, the sub-investment grade book also remains almost unchanged. What is relevant is the outstanding moratorium book that has come down to 9.7% from about 25% that was reported after the annual results. The good news is about 70 to 80% of the customers under moratorium have serviced their loans in June. However, given the size of the moratorium book, about 54,000 crore rupees, we expect bank to aggressively build up the provision. Now, in terms of business, the bank seems to be executing its well-charted strategy of bringing granularity in the deposits as well as the advances. The overall deposits grew 16% year-on-year. CASA was stable at 41% and the share of the retail term deposits plus CASA was close to 83% of the deposits, lending stability on the liability front as well. Now, net interest margin declined by 15 basis points sequentially to 3.4%, partially on the account of accounting changes as well as the excess liquidity. Now, while the reported loan assets grew by 13%, the change in Axis Bank is better understood by looking beyond the headline number. The incremental lending quality has been improving with the exposure to better rated assets and smarter sourcing of unsecured exposure in the retail, which is 19% of the retail assets. Now, the bank has done a commendable job on cost optimization and has brought the operating cost to assets to its targeted level of 2%. Now, should this improvement sustain, it could be an earning kicker once the growth returns meaningfully. Axis Bank had raised about 12,500 crores by QIP in September 2019. It therefore has got adequate capital support amid the crisis. It has a capital adequacy ratio or CAR of 17.47%. However, it is still contemplating raising more capital right now. Now, the only area of big disappointment was the steep decline in the core fees to the tune of 38% year-on-year and 48% or 44% Q-on-Q. And this was attributed to factors like decline in loan processing, lower card fees due to the lower issuance and service charge waivers, etc. But this is definitely an area that we'll be tracking closely going forward. Now, given the uncertainties of COVID-19, we do feel that Axis will continue to step up the provision even with the extension of moratorium, and also this may impact FY21 earnings as well. The current risk reward is favorable and investors can actually look for a gradual accumulation for the long term as well.